Good morning. This is Connor from 0DTE Traders here to present the week ahead for January 20th, 2026. Let's dive in. To start the week, GEX, which measures dealer gamma exposure, is 10 million notional, which has been the theme over the past few trading sessions. Very neutral, bulls slowly losing control. Although we're technically in negative gamma here this morning because we're opening up with a significant gap to the downside, about 1.7%. So GEX is more like negative 600, negative 650. And we can see those transitional levels on our SPX notional gamma chart. 6940 is our flip level. As you can see, all strikes above positive, that is supportive for the market price. All strikes below negative, that is destabilizing for the market price. In other words, when you're above the flip, dealers buy weakness, sell strength, which is what we refer to as the buy the dip regime. Conversely, when you're below the flip, dealers start to chase deltas. They sell weakness, they buy strength, which leads to more volatility. Now, our secondary transitional level is the zero gamma level. That is currently 6,900. And this is the level where that gamma index actually turns from positive to negative or vice versa. And pre-market here, we're below both 6,940 and 6,900. This is the SPX return distribution chart with each dot representing a day, the zero gamma level here in the middle, to the right, positive gamma, to the left, negative gamma. And as you can see, below that zero gamma level, the return distribution widens, meaning expect more volatility on both the downside and the upside. Below 6,900 opens the door to our put wall, which is deemed our downside target and lower bound. That is currently 6,800 for the SPX and 680 for the SPY, which is about SPX 6823 equivalent. Transitioning to the SPX on the 1 hour chart, there is this rising wedge pattern, which is quite significant. If we look at this upsloping trend line, it is multi-month, connecting the low from November, December, January, and we tested it several times last week, closing at it on Friday. And as we know, the more times we test a level, the more prone it is to break, and we are breaking it to the downside in the pre-market. It's quite a bloodbath here. SPX set to open with a big gap to the downside, 1.7%. All indices in the red, all sectors in the red. So a risk-off move, a negative feedback loop is most certainly in the works, which opens the door down to that put wall zone. Now keep in mind, with these key metrics, they are not static, so they can shift day to day and often do. So if we do see a shift lower in that put wall, it would be a bearish indication, telling us that puts are being added further out in time and price, effectively shifting lower our lower bound. Even if that occurs, 6,800 is still going to be a big zone where we could potentially see a relief move to the upside. Now, same thing here with the flip, zero gamma levels. They can shift lower, particularly that flip, which is a leading indicator of risk on, risk off. So again, risk on above, risk off below. So bulls are going to have some work to do here this week. They're going to need to reclaim these transitional levels wherever they may be and reclaim that 6,900 handle. Now, in the event we do break 6,800, there are two gaps on the downside, 6792 to 6775 and 6758 to 6721. In terms of the implied move this week, options are pricing in a 2.2% move over the next 5 trading sessions. That is an implied low of 6787 and an implied high of 6793. Keep in mind that's a 1 standard deviation range, meaning that 68% of price action this week should be within these bands. In regards to this rising wedge pattern, there is statistical probability of 68% to resolve to the downside, and that is according to Thomas Bulkowski, which is clearly playing out here. Another chart pattern to focus on is XLK on the daily chart. So this is the technology sector for the S&P 500, which is about 33% weighting. So it's very, very important. And as we see, this is a pennant structure forming a series of lower highs and higher lows, and essentially at that apex point in a very narrow range over the past couple weeks. And as we know, volatility contraction leads to volatility expansion. And as a pre-market, this is resolving to the downside. Option expiration is now behind us, so that was last Friday, and a lot of the supportive mean reverting flows that were active last week have significantly diminished. In other words, it's going to take less demand to push and hold price higher and less supply to push and hold price lower. Option expiration is associated with turning points in the market. So what we're looking at here is the SPX on the daily chart, with each vertical bar measuring an option expiration. And we can see there tends to be turning points post OPEX due to these option dynamics, and that next directional move starts to form, and it looks like we're starting to perhaps see that to the downside here, breaking some of these key structures. Popping over to the VIX chart on the 1 hour time frame, vol is exploding higher, trading above the 20 handle. Now the VIX did wake up last week, I believe on Monday, with a gap up, and we had lots of activity in the VIX with an upsloping trend line, so volatility has been in a minor uptrend. Now the real question here is, where is resistance? Where might we see a VIX peak? Where are vol sellers going to come in? And there are a lot of key levels on the upside. So first, 19, which is the max pain for Wednesday's VIX option expiration. So this is a potential magnet over the next couple of trading sessions. 20 is a very call dominant strike. So if you have a lot of calls here, there is incentive for dealers to kind of push price below 20 going into Wednesday's expiration. Now keep in mind, VIX expiration is in the morning, so this would really be a dynamic that would potentially play out over the next couple trading sessions, but it's not a guarantee to happen. If we continue to hold above 20, it opens the door to 22, 23. And if we zoom out to the daily chart here, 22, 23, historically we've seen a lot of peaks off this zone. So that's volatility sellers coming in, crushing vol, and SPX is squeezing higher. So this is going to be a key level to watch for a potential peak. Above that, 25, followed by 28, which we've also seen kind of several peaks off of as well. And these were major peaks that completely reset volatility and essentially printed lows in the SPX. So point is here, VIX is going to be key this week for determining direction and the presence of those feedback loops, both positive and negative. On the economic calendar, Thursday will bring a slew of key economic data, including GDP, the Fed's preferred inflation metric, PCE, and personal income and personal spending from October and November. So this is delayed data. On the earnings calendar, well, earnings continues to ramp up. We got Netflix, Johnson & Johnson, and Intel, the major headliners this week. All right, guys, that's all I have for you. If you're not a member and you're interested in learning more, visit our website at 0DTEtraders.com.